Hey guys, Richard Matthews with Matthews Wealth Management. We're going to be breaking down fees today, specifically looking at the different ways that financial professionals invest money and then what fees are associated for the investor. So the assumptions that we're using today is that we're going to break up investing not just in one way, but have it in different types of vehicles, different types of accounts, and therefore we have very different fees. So the first thing we're going to do is we're going to look at having $1 million across the board and how 3 different types of investment professionals invest that money and then what it costs you. So let's jump into it. The very first one we're going to look at, let's say we're investing 250 grand of an investor's money into mutual funds, and specifically we're talking about retail mutual funds. If you want to know what that means, we've got some videos out there that can help you, but specifically an A share. So A shares have a front end load, which is basically a commission that's payable to the broker or the salesman that you're working with. So in this case, 5.75% equals over 14 grand of your money that comes out before you even get it invested. So that's a typical percentage out of $1 million you would see put into A shares. Next, we're going to look at ETFs. ETFs are exchange traded funds. In this example, we're going to put 30% there. Exchange traded funds have lower costs than mutual funds because there's no secondary manager out there making decisions on buying and selling. So in this case, just 0.5% in the first year is what we're going to pay, and that's $1,500. So now let's look at that variable annuity. Variable annuities are life insurance contracts that take lump sums, and they have typically very high fees associated with them. In this example, we've got 200 grand invested in a variable annuity with all sorts of guarantees and minimums, etc. And so 4% is pretty normal for that world, which would be another 8 grand in fees coming out of your investment. Next, let's look at a fixed annuity. A good example of a fixed annuity nowadays is not the one that pays a traditional 3 or 5%, but one that would be linked to an equity index, such as the S&P 500. Some of them now track the Dow Jones or gold indices, but they typically have an internal cost, either from a cap or a spread, all sorts of ways to derive this 1%, but they've got to make their money somehow. So that's roughly $2,000 that you're giving up off of that amount. A stock and bond wrap account typically would be associated with a third-party manager where they might take this and put it out to somebody that we'll never meet, and they charge another fee on top of that of another 0.5%. So here out of that 50 grand, that'd be $250 in that year. And in this world that we're representing here, there's no advisory fees, so you don't have to worry about any kind of cost associated with that. So you got 14 grand, 1,500, 8 grand, 250. And so we've got a grand total here of $26,125 that's coming out of the investment of $1 million. And this is just in the first year. A lot of these things have recurring fees that go on an annual basis. But this is an example of what we would call a commission-based broker. So somebody that's just going to sell these products and put you into it and then go get the next customer. So that's the first area we want to talk about. We're going to kind of repopulate the board and talk about the next one. All right, guys, we're back. We're going to now talk about another type of financial professional and how they may allocate the funds, and also how the fees change up a little bit. So what we're going to cover here, basically the same allocation between the types of investments. So we've still got 250 grand, but one of the big things that changed under this mutual fund is we're no longer dealing with A shares. Now we're into the investor shares or the institutional shares, but we've moved away from strictly retail as far as A, B, and C shares. So instead of 5.75, we're down to 1%. So that really cut our costs here down to $2,500. That's good. ETFs, the exact same thing, still spending $1,500 on the 300 grand there. They're still recommending the variable annuity with its high fees and high commissions. So we've got $8,000 coming out of the investment for the variable annuity. The fixed annuity here, we've got the same 200 grand, the same 1%, so 2,000. Same thing on a wrap account. However, there's a major difference here under an advisory fee. So now we're going to be charged a fee for the advice that we're receiving to go ahead and diversify our savings into these different products. And for that, we're going to be charged a 0.7%, which is very nominal. Actually, that's on the lower end for advisory fees, but you see these fairly common, and it's because they're able to double dip. They're charging the advisory fee, but they're also receiving the commissions on top of it. So if we look at the total amount here, we've got $21,250 that's coming out of our savings in that first year for costs, and this is what we would call fee-based. Okay, so we're going to come back and give another picture of a different way to invest and kind of see how the fees compare. So we'll be right back. All right, guys, we're wrapping up here. The third and final way that we're going to invest money, roughly $1 million is what we're working with here. So we're going to look at the different allocation, the different fees associated with it. So let's see, the first thing we're going to look at, we've got a slight tweak on allocation when it comes to ETFs as well as mutual funds. We've got 300 still at 0.5% because we're dealing with the investment grade or institutional funds. So still paying the 1,500. ETFs 450. We're dealing with much cheaper ETFs here of 10 basis points, so $450. We're not doing any of those expensive annuities. Stocks and bonds, we dropped off the wrap. Wrap accounts, typically they're pushed out to a third-party manager. When you're working with somebody that manages money this way, they're doing it in-house, so you're not going to be double charged for that management. And then the last thing that we get to is the advisory fee. So a 1% is pretty common on managing $1 million, so that's 10 grand here. So if we combine all of these together, we're looking at the $11,950. So when we're talking about this methodology of investing and this investment philosophy and fee structure, this is what we call fee only. Okay, so a fee only investment advisor is not earning commissions. These are actually leaving the account and it's going to third-party people who run the mutual funds and run the ETFs, but there's zero commissions. Now, one of the interesting things when we're comparing these three is this advisory fee is explicitly stated on a statement. So when clients review a statement from a custodian like Fidelity or Vanguard or Schwab, they will see this dollar amount, and it tends to spook people. But all of these other areas with the variable annuities, the mutual funds, the fixed annuities, the wrap fees that all show in this $26,000 and the $21,000, they're in those thick books that nobody bothers to read. So you can really see how much easier it is to make money when you're not giving away 100% loss that we refer to as fees. So the second piece that matters a lot is you're typically getting a better rate of return by having a professional investment manager take care of the money, as well as the tax planning, the estate planning, looking at budgeting and projecting out and developing a target rate of return. You don't typically get that in here as far as comprehensive financial planning on top of professional money management. So Matthews Wealth Management is fee only. That's what we do. So this is why I'm pushing this type of a description of how fees work. But if you have any questions, feel free to give us a call. Hopefully this has been helpful, and stay tuned, come back for more.